Okay, so welcome back. Today we're going to go over more of call options. Up on the screen here we have an options chain for SO, which is Southern Company. It's a utility company. I currently own 300 shares of the company. So today we're going to go over selling contracts on those shares that I own. So those who haven't seen the previous video on what call options are, uh, buying a call option gives you the right to buy a stock at a certain price before the expiration date. So we're going to close out the put side. So the puts are usually on the right and calls are on the left. So we're going to close out the put side because we're just going to focus just on the call options. So up here we can see the call options for options that expire in 18 days. So this will be the March monthly call options. So they expire March 19th. So just 18 days away. So we're looking to sell some call options on the stock to generate some additional cash here. So um, my cost basis on the stock right now is around 59, just under 59 bucks. It's about 58 and some change. So it's trading below what I paid for it right now, but I mean I am looking to sell the $60 call options because that is a good price for me. I mean, here it's showing that they have a 23.31% chance of hitting $60 by the expiration date. And that's typically where I like to sell my call options, around the 25% range. So, I mean, as time goes on, you'll get more comfortable and selling them where you want to sell them at. I mean, obviously you can sell them closer to the money, and you can obviously get more for them. I mean, here they're trading at 33. You go 50 cents less, you can get them for 48 cents. I mean, it's just whatever you're comfortable selling the stock at, because you got to remember when you sell the call option, you are giving up the rights to that stock, so somebody can buy them from you at any time. Typically, as long as your stock is your contract is above the stock price, they're not going to buy them from you before the expiration date, unless there's a dividend factor coming into it, where they want to buy the stock now so they can get a dividend. But typically you don't have to worry too much about that, especially if you're selling options that are out of the money and they remain out of the money. So obviously, out of the money is just when the contract is a higher than the strike price of the contract is higher than the stock price. So here we're going to go ahead and put an order in for the $60 one. So the reason, I mean, we'll put the order in shortly, but the reason why we're picking the $60 one that expires in 18 days instead of ones that expire, in 4 days. So you can see in 4 days, we can get 3 to 9 cents is what the spread is right now. So it's not too much. Yeah, it's only expiring in 4 days, and then we can do it again the next week. And then you have, the March 12th ones that are expiring, in 11 days, and they're trading between 15 and 21. So we extended out one more week, and we get 33 to 38 on the spread right now. Um, so what why I'm going this far out is I just want to get as much credit as I can now. So one of the good things about selling call options when you already own the stock, so you're using the stock as collateral, you can immediately use the credit you receive from selling this call options. It goes right into your buying power, and you can use that to buy other things. So I mean, you can buy stocks with it. You can buy other companies' options for it. I mean, you could do with it as you wish because it goes right into your buying power. So obviously, the higher the credit you can generate now, the more money you can use right now. Yeah, you do have to wait, for this one 18 days to expire to be able to do it again. But it does. There's obviously time value in money, which is what we're going over, in this video here, and that is, theta. So, in the last video I just briefly mentioned, the five Greeks. So they're called delta, gamma, theta, vega, and rho. One of the ones that I focus on quite a bit when it comes to selling options, especially covered call options, is theta. So theta is like the time decay. So what theta here is representing is how much this contract is decreasing in value per day, holding everything else constant, obviously. So this is, has nothing to do with if the stock price stayed the same, how much is this contract going to go down every single day. So for the $60 contract here, we can see it's going to go down, 2 cents, like 2.15 cents per day. And remember, contracts are 100 shares per contract, so you have to multiply this by 100. So that, the overall price of this contract is going to go down $2.15 per day. So obviously you can start getting, you sell 10 contracts, now you're getting $21 a day. You sell 100 contracts, you're getting $216 a day. So the theta can definitely add up by subtracting the value of your contracts. So it's definitely a good tool to look at when it comes to determining if you're good with this. So theta typically increases as you get closer to the expiration. So just for example, to pull up the same one, so here, and the market's open right now, so all this data is constantly updating. So if you notice it changing, it's just the market. So if we look at the $60 ones that expire March 18th, it's the theta is negative 0.0220. Okay, so let's compare that to the $60 one of the March 5th. So here it's 0.0246. So you can see it's decreasing faster because the expiration date for this one is only 4 days away. So you can generate money faster the closer you get to the expiration date. But obviously there's only available between the bids at 2 cents and the asks at 9 cents. So I mean, if you want to get filled, you're gonna have to go somewhere between there to get filled, given everything else the same. So obviously theta will adjust as the price changes as well, and as time goes on. So theta and all the Greeks for that matter are only measuring one aspect of the option price of the contract. So even though theta can increase and decrease itself as the stock price goes up or down. So you usually have to take that into consideration as well. But if it's just one of the factors that you look at when it comes to determining which one you're gonna sell. And I mean, you also use different Greeks depending on what your strategy is. So people that are doing the covered calls like we're talking about here in this video, theta is one of the big ones that you pay attention to, because you're looking for that time premium. You're looking to capture time. I mean, time is money in this aspect. Time is always money, but in this covered call example, it's 100% time is money. So you're going to get a higher theta the closer you are to the money, because the stock prices are higher. Because the option prices are higher. So going back to the one that we're going to be doing here trading today, so we can see this is between 33 and 38 on the $60 one. I have 300 shares of SO, so we're going to be selling 3 contracts. So the bid's at 33 cents and the ask's at 38 cents. A lot of times you can sell options at the mid price. It doesn't always guarantee execution right away, but you can typically put the order in there and you can generate. So we're just going to put the midpoint in. If it doesn't get filled pretty quickly, I will eventually adjust the order down to the bid. But we'll try to capture a couple more cents, just because the spread is so big. I know in a previous video I said I typically just take the bid, but when the spread's a decent size on a stock that's heavily traded, we'll sit there at the bid. At the mid, and see if we can get filled. If we don't, we'll adjust it down. So let's go ahead and put the order in. So we have to sell 3 contracts. So we're going to generate $103, and this is for 18 days. So again, you can do the math in your head, or you can just look at theta. So theta is right now it's 0.224, and the Greeks are always based on the midpoint of the options. So, and look, the option price just ticked up to 36. So let's adjust our order really quick. Okay, back to 36. All right, as we were. So you can see $106 for 18 days. So how much does that mean you're making per day? So you can just divide that by 18, or you can look at theta, and theta is 2.259 $6 per day. So we have 3 contracts. You times that by 3 in your head, you're at $6.75 a day. Obviously, it's pretty good. I mean, I already own the shares of the stock, so this is any additional cost. So let's just go ahead and get this order in so it's out there. So at 36. All right, and we got filled at 36. So right there, money is in the account right now. I'm able to use that, and I can use that buying power to purchase additional things. So I mean, it's just one of the great things about options. In the later video, probably one of the next videos coming up, I'm going to show you what to do if the stock price goes above $60 and you still want to keep the shares. So I do want to keep the shares myself, but there are stocks out there that if they go above my contract price, I'm okay if the shares get bought from me. In this case, I do want to hold on to this stock. So in a next video, you'll see what I will do to still hold on to the stock by doing what's called rolling out the options, and you will still generate a credit by doing that and also increase the strike price. So it's definitely a good strategy for those who end up having a contract that's in the money but they want to hold on to the shares. So definitely subscribe to the channel so you don't miss that video when it comes out. And if you like this video, please give it a like. Definitely helps the channel out. And there's a link to the Discord in the description, where we have lots of stuff to talk about when it comes to options and stocks and other things that relate to the channel and investments and all that stuff. So anyway, thanks for watching, and until next time, guys.